Bill,
Yes, ma'am.
you want to hit view up there and then do full screen or something because it's a little small.
Yeah, it's cut off at the bottom.
Yeah, go down to full screen mode. See it? There you go.
There you go.
Yay!
There you go. All right. Well, welcome everybody. This is Home Buying, and we are the presenter is Crystal Avery-Morris from Commerce Bank, and I'm gonna let her take over. And I think she has her co-worker Maurice on here, so I'll let Crystal handle the questions. But we do have a chat feature. If you do want to put some questions in the chat, I will be monitoring that. So Crystal, take it away.
Fantastic. Thank you so much, Yvette and Carol. I am very appreciative for the opportunity to share in collaboration with Prosperity Connection. Again, my name is Crystal Avery-Morris. I am the Community Development Officer for Commerce Bank. Joining me today is my co-worker, Community Home Loan Originator, Maurice Allen.
Hello, everyone.
Hey, everyone. Today, we are going to talk to you about how to get approved for a mortgage loan and some other details that will help you to facilitate the transaction and make sure that it's smoother for you and give you some information that may trigger some questions that you may not have considered prior to attending this presentation. So again, thank you for joining. So just to get started, how do you get approved for a mortgage loan and realizing the American dream? We're going to talk about mortgage loan basics, who can get a mortgage loan, how much you can afford, and how much will a bank loan you. I emphasize you on those bullet points because when you get ready to buy a home, you'll tend to have more conversations about it with your family members, with friends, with coworkers, and you will think that everybody's in a similar situation. But purchasing a home is a very individual type of circumstance. It's specific to you, and everybody's situation is different. There may be some similarities, just like everybody's fingerprint is different. Most people have a hand, and most hands have 5 fingers, and most people have fingerprints, but everybody's fingerprint is different. So your situation for purchasing a home is going to be different than your peers. We're going to talk about strategies for finding the right lender for you, working with the mortgage lender, how a lender approves your loan, and your rights as a consumer. Let's just jump right into it. So when you are purchasing a home or considering purchasing a home, you'll have a mortgage loan. And the first thing you want to think about is how much is the payment going to be on the loan and what does that payment consist of? Your house payment has a couple of components included in it. The first thing is the principal and interest. So if you see a home that's listed for $100,000, you're not just going to pay $100,000 for that home. You're going to pay that $100,000 plus interest. And that's the interest rate that is ascribed to you when you go in to get approved for your mortgage loan. You're also going to pay real estate taxes. All real property in the domestic United States and even abroad has some sort of tax associated with it. Now, your property taxes may be different on one side of the street than it is on the other side of the street, which will impact your overall payment. But property taxes are a part of your monthly mortgage payment. You also have homeowners insurance as a part of your payment. Your homeowners insurance is the insurance coverage that you pay for in the event that you have let's say Hurricane Katrina or some type of disaster at your house. That's that type of insurance. That's the insurance that you would get from a provider such as American Family, Geico, Progressive, Liberty Mutual, something like that. There's that kind of insurance. And when you're trying to source that insurance, my recommendation is that you start with the insurance company that provide, if you have car insurance, I would suggest that you start with that particular provider because they may be able to do a bundle type of deal for you to give you a lower payment on your car insurance just because you're including a homeowner's insurance in there. An additional type of insurance that may be applicable for your loan, depending on the type of mortgage product that you use for financing is PMI, or private mortgage insurance. Private mortgage insurance basically insures the bank against your default against of the loan. So that says that if you default on the loan, let's say for instance, if Wells Fargo provides a mortgage for you and you default on your mortgage loan, that says that Wells Fargo is going to be protected from that loss. They're not going to lose that money. Granted, there's still going to be a foreclosure on your credit, and they're still going to make you leave the house. They're still going to, you have to vacate the home, but Wells Fargo's financial interest is protected. You have to pay PMI typically if you do not have at least a 20% down payment on your mortgage. If anybody in here is already pre-approved or pre-qualified to purchase a home and you are looking at using FHA for your mortgage financing, you are going to have to pay PMI for the entire amortization or the life of your loan. So if you have a 30-year fixed rate loan, you're going to be paying PMI for that entire 30 years. Contrary to that, if you decide to select a different type of financing, perhaps a conventional financing, which we'll talk a little bit more about later in the presentation, that PMI will disappear once you reach a 20% equity position in your mortgage. So what I mean by that is once you've made enough payments that are equivalent to 20% of your loan, then that PMI will fall off. Banks also have they have portfolio loans where PMI may not be applicable. But again, we'll talk more about that further into the presentation. Another part of your house payment are your condo association fees. If you are looking to purchase a condo, which a lot of people are, they will prefer to purchase a condo over a single family residence, just a regular house, because of the upkeep. They don't want to cut grass. They don't want to do those types of things. So they will rather just purchase a condo. Well, if you purchase a condo, you are subject to condo association fees. And sometimes your condo association fees can be equivalent to or more than the principal and interest payment that you're paying on a home. So you want to think about that if you decide that you want to purchase a condo. Steps in obtaining a loan. You want to look at lenders, a couple of different lenders, choose a lender that you feel comfortable with and apply for your loan. You want to get your lender's pre-qualification and provide documents for loan processing. So when you are providing documents for loan processing, those are the documents that a lender is going to use to make a decision about whether or not you meet the qualifying criteria for the loan program that you are applying for. Those documents include, but are not limited to, your most recent 2 years tax returns, all pages of your tax returns. If you have a business, they're going to be looking at both your business and your personal tax returns. They're going to be looking at your W-2s or your 1099s if you received them for the most recent 2 years. You want to provide both. Oftentimes people will say, well, I gave you my W-2 so you know how much my job paid me. Well, the reason that I mentioned your taxes first is because your taxes are going to provide a more complete story of your earnings for the most recent 2 years, because your W-2 will only show you only show a lender what that particular employer paid you for the calendar year. For example, you work at Walmart, you make $40,000 a year at Walmart, but also on the side, you also take photos on the side. Well, you file those photos on your taxes, you filed a loss because you had to buy a camera and a tripod and all that type stuff. So you said, well, I didn't make any money from my photography business, so I filed a loss. Well, you might, if you file a loss, let's say of $10,000, well, instead of the fact that you've made $40,000 as mentioned on your W-2, now we may only be able to give you credit for $30,000 because you have a $10,000 loss based on your tax returns. That's why it's important that we have all pages of your tax return so we can really determine how much you can qualify for. So you need your most recent 2 years tax returns, your most recent 2 years W-2s and 1099s. You want your paycheck stubs for at least the absolute minimum for at least the most recent 2 months, sometimes even 3 months. So if you get paid every week, the 8 paycheck stubs every 2 weeks, 4 paycheck stubs, 4 or 5, however many paycheck stubs you have for the most recent 2 months, you want to make sure you provide that. You want to provide your bank statements, all pages of your bank statements for the most recent 2 months. If you are self-employed and you have a business bank statement and you also have your personal bank account, they're not going to use the money from your business bank account to help you to qualify for a loan. The reason being is because the money that's in their business account has to stay there in order for you to maintain operations of your business. I see that a lot of times when people say, well, I put all my money in my business account and I put it in my personal account. Well, that could be a problem. So if you know that you're going to try to qualify for a mortgage loan, you want to go ahead and start separating those two things so that you can at least provide 2 to 3 months worth of bank statements showing where you have funds in your account. The other thing that we are looking for in accounts when we're looking at your bank statements, we're looking at the balances and your ability to be able to maintain a balance that is enough to satisfy the needs of this loan that you're getting ready to do. So if you are trying to buy a house and you know that you're going to need $5,000 to complete the transaction, they want to see that you have that money available in your account. And you say, well, I'm going to get, some first time home buyer assistance. I'm going to do this, or I'm going to get some money from somewhere else. But they're going to want to see that you have some money saved towards the transaction, or basically some skin in the game, because there are certain things that you're going to have to pay for up front that first time home buyer funds will not cover. Things like an appraisal or an inspection or earnest money, for that matter, are fees that will come out of pocket up front that will not be able to be covered by a first-time home buyer down payment assistance program. So you want to make sure that you have those funds available. If you receive any supplemental income, let's say, for instance, if you receive Social Security, you want your Social Security award letter, and again, that 1099 document showing how much they paid you for the most recent 2 years. If you receive child support, you want your child support award letter and proof that you have received your child support on time for at least the most recent 12 months. Oftentimes people will say, well, I'm supposed to get child support, but I don't get it like I'm supposed to, and it's not consistent. Sometimes a lender is able to average the amount that you have received. Even if you get it every other month, they may average what you've received over 12 months to give you an aggregate for qualifying purposes. Any questions about that so far? That was a lot of information. No
I
questions?
don't have anything in the chat.
Okay. All right. All right. So after you provide your documents for loan processing, the loan officer is going to take those or give those documents to a processor who is going to make sure everything is turned in the way that it's supposed to be. And they're going to forward it to an underwriter. An underwriter is basically like a teacher to make sure that you got all the right answers. She's the person, or he's the person with the red check mark or check pen to make sure that everything is correct. They're going to review it and make sure that they have every single document that they need. Oftentimes when you're going through this process, you may have a loan officer ask you for something 2 or 3 times. And if they do, don't get frustrated. Just give it to them and make sure that you have those documents on deck, copies of them on deck, whether they're electronic copies or paper copies, so that you can provide the information. And once the underwriter reviews it, they're able to give your final approval. All right, Maurice, you want to take it from here? Can you take it from here? From starting with 4 C's of credit?
Sure. So hello, everyone. So everybody, whenever you're going to a lender, these are typically generally what they're going to be looking for. The 4 C's of credit, which are capital, capacity, credit, and collateral. So the first one we're going to go over is collateral. So collateral is the down payment. I'm sorry, capital is basically the skin that you're putting in the game or into the transaction. So a lot of times sellers, lenders, they want to see what skin in the game or skin in the transaction you have. How much are you putting towards into the transaction? All right. So that can show from, the money you're putting for a down payment, for the loan fees, closing costs, escrows, reserves, and moving expenses. So for the down payment, that can vary depending on which program you're going to be using or the lender has you pre-approved for. So that can be conventional, VA, FHA, and each program has their own requirements as far as how much down payment you have to put down on the purchase. The upfront loan fees, that can be your appraisal. Most of the times you have to pay for your appraisal upfront, okay? And so another upfront fee is your, sometimes they'll collect the money for the credit report that you're paying for as well too. Closing costs and escrows. Closing costs are going to be your title company fees, as well as the fees that the lender is going to charge you. Your escrows are going to be your taxes and insurance. So basically, whenever you have a mortgage payment, your taxes, and please excuse me, you might hear a baby in the background. She's learning too. I'm trying to teach her home buying 101, starting at an early age. So for your escrows, your insurance and taxes are going to be rolled into your mortgage payment, okay? But at closing, we actually have to collect the fees to actually start that account. So that actually comes out at closing as well. A lot of times, depending on the program that you're going to be getting financing for, there may be reserve requirements. And a lot of times those reserve requirements is based on the actual monthly mortgage payment that you're having to pay, okay? Or the aggregate of mortgage payments you're paying if you have other properties that you're making mortgage payments on, like say investment properties. And then you got your moving expenses. So don't forget about that. Don't put all your money into buying a home, and then when you're at closing, you sign the dotted line, and then your bank account is zero. You can't move into the house because you can't afford, movers. Because nowadays people, don't want to, get paid by, Little Caesars and Bud Light. Like you might have to bring a little bit more and actually pay for a moving company nowadays. But I digress. Let's move on. So capacity. So this is very important, okay? What is your current income? All right, and we're talking about recorded income that we can improve, not income that you have a side hustle, you sell little Debbie snacks on the side, or you cut somebody's grass on the side. This is recorded income that needs to be traced via through pay stubs, W-2s, as well as sometimes some banks or some lenders want to see it coming from an auto pay to your bank statements, okay? So we're gonna look at your current income, and we can look at all sources of income that's reported. That can be income that you're receiving from a retirement account, Social Security income. So anybody that's on fixed income will need to verify that as well as other like investment or income you get from investments. Then we look at your income history. How long have you been receiving that? Okay. So let's just say everybody got their stimulus check money, and some people may have wised up and bought an investment property or something like that, or they may have bought like some stocks, and they're getting some dividends just now. Well, a lot of times, if you're wanting to count that as income, you most of the times have to show that that's been coming in for at least 2 years or more. Okay, so just because you done hit the come up and you're moving up, which is good, you have to show history of moving up. Okay, because history also shows stability.
I'm sorry, go ahead.
What you
So
say, Crystal?
one thing I'll add to that is not only do they want the history, but they also want to see the continuity. So they want to see that the income that you receive has the likelihood to continue for at least 3 years. For example, if you receive child support and you're depending on that to help you to make your mortgage payment, you want to make sure that that child support is going to continue for at least the next 3 years. So if you have a child that's 15, then technically that child support is going to end at 18. And I know that there's some um, caveats there where say, well, they will continue to get their income until they are 21 or until they graduate from college. And I get that, but the onus would be on you to prove that that would be the case. Otherwise, they're going to stop counting that income once that child ages to 18, and then they will thus discontinue that child support income, and they wouldn't be counted for qualifying purposes. And I only
Yeah.
mentioned that because I had a situation that was like that where a lady was getting substantial amount of child support every month, a couple of thousand every month, and she was depending on that to qualify. But because the child was over 15, we couldn't use it, and so she therefore couldn't qualify for the home.
Yeah. Yeah, and so that's where I guess the future earning potential, which is the next point, comes in. For some people that are graduating from a program like that's a training program, let's just say it's community college or a university. If you have a degree and you have a job offer that's showing the potential earning that you'll be getting, now that's different from showing income history because there's earning potential there. But most of the times you need to show some type of income history to show some stability. All right, we can keep moving on.
All right. One thing I'll say about future earning potential is kind of like if you are LPN or CNA and you're in nursing school, you earn one thing at that rate. But once you graduate to become an RN, we know the RNs make more money than an LPN or a CNA. So if you get an offer letter from a job, like right now you're making $24,000 a year, but then you get an offer letter from BJC, to start there to make $60,000 a year, and you're gonna start, I guess, within 45 days or something. That's great. They can consider that. But before you close, I think they will likely want to see at least 1 or 2 paycheck stubs from you to show that you're actually making that money. And then we talked about the amount owed on your talking about your credit cards and stuff like that. So if you have, hi Natalie.
Say hi.
But if you have credit cards, let's say, or a car note, and you are attempting to qualify with those, but let's say, for instance, you only have 3 payments left on your car note. Your car note is $300 a month. Well, we know that after those 3 months are over, you'll have an extra $300 that you could apply towards your monthly debt that you're paying. And the same thing will go for any other accounts that you have. If you know that you're within a certain time frame of paying them off, then that's something that we can consider. Most of the time, they want to see that you have less than 10 payments, but because the industry right now is so volatile, a lot of times people's jobs are volatile. I think that the unemployment is leveling off now, but in 2020 and the very beginning, where we're just in the Q2 of 2021, employment was really volatile. People were still losing their jobs. So they want to see that, that you're able to maintain the payment that you are applying for once that payment, whatever that installment account payment is that you have is paid off.
Looks like we got some questions, Crystal. So the first question comes from Tiffany Butler. She says, hello, what types of questions should we ask the lenders? And I think that's something we're going to cover later on in this presentation. Is that correct, Crystal?
Yes, it is. Just a question that you should be asking. And Crystal Hall, I like your name. It's a beautiful name and it's spelled correctly. Are student loan payments included in the amount allowed? Yes, they are. Maurice, I'll let you talk about student loan payments. They're the bane of my existence. I hate student loans.
Oh yeah, oh yeah. So let's continue. So another thing that lenders will look at outside of the capacity. So I think you may have touched on the amount owed, Crystal, but we're going to look at your liabilities. We're going to look at your monthly payments. So we will look at your total balance. But we're going to also look at your monthly payments. And so what we look at is a debt to income ratio. And so each program, each financing program has a different requirement as far as what the debt to income ratio maximum will be. Conventional has theirs, FHA has theirs, VA has theirs. And then you might have some lenders that have portfolio programs that have their own debt to income ratios. And that just means that based on the income you bring and the amount of monthly debt payments you're making, you can't over exceed a certain percentage, okay?
All right. And we'll talk about, we actually have a slide for that.
Yeah.
We'll talk about.
So we're going to look at your credit. So whenever banks or lenders pull your credit report, we're going to do a hard inquiry and we're going to look at your credit score, which is going to be your FICO credit score. Okay. So your FICO credit score is going to be the middle credit score from TransUnion, Experian, and Equifax. All right. But we're also not just going to look at your score, because you may have a score that may qualify on paper. You know, sometimes they're going to look at other factors, your credit history. And on your credit history, it's going to show if you're paying bills on time. How much credit are you utilizing? Are there any blemishes on your credit report, such as collections, judgments, or liens, tax liens? A lot of times, based on those derogatory blemishes, it can be an automatic denial based on the program you're trying to get approved for. And then what combination of debt do you have in your credit report as well, too? So all of those things are going to contribute to the actual credit score that you have and your overall credit status, all right? So when we pull your credit report or your credit report, is not, your credit score didn't come from us just pulling your credit report, okay? It's these factors that play into it, okay?
One thing I'll add to that is that, and I was trying to pull up the information. When we pull your credit, it's going to show anything that was reported to the three major credit bureaus, like Maurice mentioned, or Experian, Equifax, and TransUnion. But in 2017, I believe meaning the credit bureaus, stopped reporting things like judgments on your credit report. Doesn't mean they aren't still there, but they stopped reporting them. If you aren't aware of those things, if you aren't aware that you have those types of judgments or liens on your credit report, then you don't know to get them resolved before you start applying for a mortgage loan. One thing that you can do is to reach out to the company that banks use now to report those types of judgments. Like, and the name of that company is LexisNexis. It's LEXIS Nexis, NEXIS. And their phone number is 888-497-9172. Again, it's 888-497-9172. You can actually reach out to them and ask them to start an investigation on you to see if there's anything that pops up. And if it is, it's going to take them about 30 days to get it done. So you want to start this sooner rather than later. And if there is, then, and you find out about it, that'll give you an opportunity to get that taken care of prior to run into a situation where you think everything is going to be all right. And then you have a lien pop up.
Is there a charge for that service, Crystal?
Nope, not that I know of. Anytime I've ever done it, they haven't charged anything.
It's free 99.
$3.99.
All right. So the last thing is collateral. Okay. So collateral is basically going to be the property itself that you're trying to purchase. Is the house worth the purchase price? Is the house in move-in condition? And is the house structurally sound and safe? Okay. And a lot of times lenders, what they use to determine these factors is an appraisal. So an appraisal is that prepaid expense that you have to pay for prior to closing that comes out. So that's something you always want to, factor into your expenses. That appraisal is going to give the lender an unbiased point of view of what the value of the house is going to be. Okay. So it's not the lender that has someone in the back office doing an appraisal. They usually will have a third party do the appraisal for you. Okay.
All right. I'll do this one. Ratio. So Maurice was talking about your debt to income ratio. One of the questions that was in here by Crystal was, are student loan payments included in the amount in this amount owed? Yes, they are, dear. Yes, they are. And we look at those, we calculate those student loan payments as part of your ratios. You have a housing ratio, which is the maximum percent of your gross monthly income that you can dedicate towards the monthly mortgage payment. And people say, well, why would you use my gross and not my net? Banks use your gross income to qualify you, and your gross income is the income that you get prior to taxes coming out. So again, the maximum percent of your gross income that can be used towards your monthly mortgage payment is your housing ratio. In contrast to your debt to income ratio, which is the maximum percent of your gross monthly income that can be used towards the mortgage payment and any other debt. So that's your mortgage payment plus your car note and your credit cards. So this pie chart kind of gives a visual of how to look at that. So this 36% right here will be considered the housing ratio. That's that debt. Plus this other 6% will be any other debt. That's, I guess, would be your car note or whatever. So you combine those two together, that's for a maximum of 42%. This other 58% that you have right here, that's for other life expenses. That's for the hairdresser, that's for gas, that's for groceries. So let's look at an example. Let's consider Sue. Sue makes $2,500 a month, okay? Oops, not for, $2,500 is Sue's income, okay? And so if we want to see how much Sue can afford, so we need to look at 42% of 2,500. So what's 42% of 2,500? Everybody got their phone calculator? Somebody put in the chat, how much is 42% of 2,500? Somebody say it or put in the chat. While y'all are figuring out that, Sue also has a $300 car note. She has a $75 Best Buy card. And she has very good, Carol, you cheating. You can't do it, Carol. So a $75 Best Buy card, and she pays $100 a month for her student loans. And I'm sorry, I didn't spell student right. I'm sorry, I wasn't a good student. I really can't spell. All right. So she has $1,050, which is 42% of 2,500. So what's 1,050 minus $300? $750. Then we gotta take out, what's the other bill? We got to take out the $75 Best Buy card. That leaves us with what, $675. Then we got to take out $100 in student loans. That leaves us with $575. That $575 is how much Sue can afford for a mortgage payment. She's not going to be able to get a whole lot of house at $575. Would you all agree? But that's how you calculate the income. When it comes to student loans, Crystal, you typically have to qualify with 1% of the balance as a monthly payment. So if you owe $80,000 in student loans, what's that times 1%? That's an $800 a month payment on your student loan that you would have to qualify with using that calculation. And as Marie said, different lenders, different programs have different calculations. So that 42% that you see right there may be 45 on some programs. On some programs, it may be 50%. But this is the thing. If you are looking to participate in a first-time home buyer program and utilize down payment assistance with first-time home buyer programs, they're typically going to have a lower ratio like that 42%. Why? Because statistics show that those lower ratios, those lower housing ratios, housing debt to income ratios, support a more sustainable and successful home ownership experience because people aren't house poor. So if you know that, hey, I'm going to be going to Prosperity Connection and they're going to help hook me up with some down payment assistance through some program or something, and that program is great, but that program requires you to be at a 42% debt to income ratio, that's what you're going to have to adhere to. So if you're working with a lender, you want to make sure that you work with the lender, Maurice, that knows the different programs that you're trying to qualify for. Does anybody have any questions about that calculation? You should be able to do that calculation with your own income at home.
And some people may ask, well, how do I qualify for more? Hey, I'm working this job. This is what I got. What are some ways, I can lower my DTI? And one way is, hey, you may have some credit card debt that you can pay off. That's not going to hurt your liquidity or your cash reserves. It probably might be good to pay those off. Or you might have a loan out there that you may have some extra cash to pay off as well. In the long run, it's going to help get you a better home or, qualify for a larger loan amount so that you have more options when you're out there purchasing.
I agree. All right. You want to go, Maurice, or you want me to take it?
You can take it.
All right. So when you're getting pre-qualified and you're thinking about the calculations and using those affordability ratios, you want to know how much money will the lender loan you? What purchase price can you afford and how much down payment will you require? Will they require? And what is your estimated total monthly payment? So when you're asking, what questions should you ask the lender? These are some of the questions that you want to ask, like how much money how much am I pre-qualified for? Basically, that's what they're saying. How much money will the lender loan you? And how much can I afford? Well, I'm sure everybody's on Realtor.com and Zillow.com and looking at stuff and looking at different payments. Well, if you use the calculation that I gave you and you play with those mortgage payments, you'll have a good idea of what purchase price you can afford. And then when you ask a question about how much down payment you will require, that will be dependent on the type of mortgage loan that you do, but it could be a deal breaker for you. And what I mean by that is if you are working with a lender and they tell you that you're going to have $10,000 as a down payment, if you don't have anywhere to source those funds from that you can document, then there may be a deal breaker for you. And what I mean by being able to document is that all funds used in a real estate transaction must be able to be sourced, or they must be able to have a paper trail. And sometimes they can get a little hairy when you have family members who want to be supportive. So you have your grandpa or your grandma who wants to help you say, you know, I'm going to help give you some money to go towards the purchase of your new house. And so they want to give you, you know, you got grandpa who has thousands of dollars in their sock drawer. And so they come and they give you $1,000 and you're very appreciative. But what do you do with that $1,000? What can you do with it? If it's cash money, it's not a whole lot you can do with it because cash doesn't have a paper trail. So the best thing to do is, if you have a family member who does want to be supportive and give you money to go towards your transaction, is to have them to write you a check. Get a copy of the check, but they're also going to have to provide their bank statement to show where they had the funds available to give to you for this transaction. And therein lies an issue sometimes, because people say, well, I'm not the person that's purchasing the home. Why do you need my personal account information? They use that to help support the U.S. Patriot Act, to help to deter money laundering and terrorism. So they want to, again, make sure that the funds that are being used in this transaction have a paper trail. So if the person that is going to be giving you money may have, you foresee them having some issues with providing the supporting documentation, an alternative way around that would be perhaps for, if they give you the money to do it, use that money to just pay your bills or whatever, and just your paycheck stub and stuff. Let that money just stack up in your bank account, because you'll be able to document where those funds came from. You'll be able to document your paycheck stubs, and especially if it's on direct deposit, you can say, okay, this money came from my paycheck stub, and just let that money gradually build in your account and use whatever cash was given to you to support your other day-to-day expenses instead of taking it out of your account. All right. Who provides mortgage loans? Banks, Commerce Bank, mortgage bankers, credit unions, mortgage brokers. Most financial institution has some arm of residential mortgage lending. Whoever you bank with, I would, ask them who their contact person is and what types of programs do they have, to see if it's anything that fits your particular needs. You want to go? You want me to go, Maurice?
I can go, and I'll just add to that. You also want to ask them if they have any down payment assistance to offer. In addition to their first-time home buying programs, they may offer. Do you have any down payment assistance? And the down payment assistance, that's something that I'll touch on in regards to the available loan programs that are offered by the different lenders. So some of the different loan programs, as I mentioned, you got FHA, conventional. So these are those loan programs. So whenever you go to a lender, most of the times, the programs that they're going to try to help get you qualified for is going to be an FHA or VA or USDA, rural development loan. So for FHA and VA, those are government loans. In the slide, Crystal, we talk about like the percentages and what their requirements are for each one, correct? We don't? Okay, so I'll touch on that. Okay. So FHA, they usually require at least a down payment of 3.5%, okay? FHA is pretty popular because of the down payment option they require for borrowers. You don't have to bring 20%, you don't have to bring 10%, you don't have to bring 5%, you can bring 3.5%. And you don't have to be a first-time home buyer. You just can't have another FHA loan outstanding right now. And it has to be for your primary residence, okay? VA, they will finance 100% of your loan, of your purchase price. Crystal, you say this all the time. If you ever have the chance, go down to the VA.
Hang out for a little bit. I always ask people, are you single? Had anybody on here that's single? If you're single, marry a veteran.
Yep.
Because the benefits that they are eligible for through the VA administration are second to none. It's 100% financing It is awesome. And with the VA loan, if you ever find yourself to become disabled or 100% disabled, then there are limitations on the property tax that you can pay as well. There's basically a lot of times your property taxes are abated or discounted, where you don't really have to pay anything. My father was 110% disabled, so he didn't have to pay any property taxes on his real estate. The other
That's
good
nice.
thing is it was really nice because, well, I take it back. They paid because they had an escrow account, so they paid in the mortgage payment. But at the end of every year, they would always get like a big $4,000 check back at the end of the year because they don't have to pay it. The other neat thing about government loans or FHA, VA loans is that they are assumable. And so what that means is that if something were to happen to you, or you wanted to get away from under your loan, someone could assume your mortgage in its entirety.
Yep.
Well, what does that mean? The best example I can give you for that is my personal example and then an example from another client. So everybody know they had the GSA that they're building down in the city, right? And so there were some people that lived down there. And so they bought those people out. And so those people got big lump sums of money, 100,000, 70,000, $80,000. And so one of my clients was an elderly lady. She was like 82 years old, and they bought her out. And so she purchased another home and she got a loan for it. And she was going to get a conventional loan until I explained to her that if she got a VA loan, if something happened to her, because she got a 30-year fixed rate loan, but she was in her 80s. So she didn't know. I mean, she could have lived another 30 years, but she wasn't sure if she was going to. But her daughter was her caretaker and lived in the home with her. But so I told her that if something ever happened to her, then her daughter could assume that FHA loan and not have to go through purchasing it or doing a whole lot of other stuff. She could just have her all of her estate planning and stuff done, working with someone to get a will and a trust done or whatever, and her daughter could just assume the loan. And she took that advice. And I took my own advice when my mother passed. My mother passed in December of 2019. Again, she and my father had a VA loan, and I established a trust for my parents and prior to them passing. And so when they did pass, I was able to assume my parents' loan with no cost to myself. And so I'm not a veteran, but I have a VA loan. So then, the USDA loans are also government loans, and you can also get 100% financing for them. They most of the time your USDA loans are, in most cases, they're in your more rural areas. So think Troy, Missouri, somewhere out there, but they are really good loans to have. Your Fannie Mae and Freddie Mac loans are your conventional loans. Those loans typically are not assumable, and those loans require, in most cases, 5% down payment and sometimes a 10% down payment. But they do have some programs like Fannie Mae Home Ready and Freddie Mac Home Possible. I might get those two mixed up, but they're Home Ready and Home Possible, where you only have to have a 3% down payment. The caveat with that is that your credit scores typically have to be higher. Whereas on FHA, they will allow you to have a lower credit score. So it kind of levels the playing field for you. You also have an available loan program through your state bond agency, or MHDC, the Missouri Housing Development Commission. And MHDC will typically give you 4% of your loan amount to go towards your purchase price. To go towards your closing cost. So if you are purchasing a home and you need some down payment or some closing cost assistance, MHDC may be able to help with that. Most people can do MHDC loans. Sometimes lenders don't like to do MHDC loans because they're not profitable and they're very labor intensive, and they have a lot of paperwork associated with them. But if you feel like that's the process or the loan product that you want to go through, you can always go directly to MHDC's website and try to qualify there. And they'll have people that monitor those applicants, and they will reach out to you. You also have programs through HUD approved agencies. And those, like when people talk about those down payment assistance programs, you can go to HUD.gov and put your address in, and it'll give you a list of at least the 20 closest HUD approved offices to you. And those offices may have some down payment assistance. Not all of them have down payment assistance, but some of them do. So you will want to inquire with them and inquire about what the qualifying criteria are. The other thing that you want to look into are portfolio programs through local banks. So some banks have portfolio programs that have some of the same characteristics that I mentioned with FHA or VA or USDA. Some banks have programs that will offer you 100% financing, meaning that you don't necessarily have to have a down payment, which is really good, because if you're purchasing a home, you're typically looking at 2 sets of closing costs: your down payment and you're looking at 2 sets of settlement charges, your down payment and your closing costs. Your down payment is the difference in between the sales price of the house and the loan amount that you get from the bank. Your closing costs are the charges that are ascribed to you to complete the transaction. So if, let's say for instance, if we were doing a Fannie Mae loan, a traditional Fannie Mae loan, and the sales price of the house was $100,000. Well, your sales price is $100,000, but a bank is only going to give you $95,000. So that's still a $5,000 gap there where you have to come up with the difference. That's your down payment. But on top of that $5,000, you also have closing costs that you have to pay. Those are, we'll talk a little bit more about them on the next couple of slides, but your lender fees, your title company fees, your state tax fees. And let's say, for instance, if those fees are another $3,000. So that $5,000 down payment plus those closing cost fees of $3,000, that means you need a total of $8,000. That's where some of these down payment assistance agencies could come into play. But if you went through a portfolio program, and Commerce Bank does have one, I'll let Maurice talk a little bit about it. If they finance you 100%, in that example that I gave you of $100,000 purchase price, you don't have to worry about that $5,000. The only thing you're thinking about is that $3,000. Maurice, can you tell them a little bit about our portfolio product, Neighborhood Connections?
Sure. So Commerce Bank currently offers a portfolio loan program called the Neighborhood Connection Loan Program. And a part of that are 2 different loan programs that we offer. So the first one is the primary mortgage that we would use to finance the purchase of your home. And that one can go up to 100% financing. As long as you have a credit score of at least 620 or higher, you would be eligible for 100% financing, meaning you wouldn't have to put a down payment on your purchase, okay? And there's no private mortgage insurance required for that as well. So you're able to save money on your monthly mortgage payment. And then there's no origination fees as well that the lender will charge you. Okay, you'll still have to pay for your appraisal. You'll still have to pay for your out-of-pocket fees, but no origination fees that the lender ourselves would collect at closing. And in addition to that, you can possibly be eligible for a $2,500 grant that can go towards closing costs. And that's based on your annual income. And that's something that once you submit an application, we would evaluate your income to see if you're eligible for that. The other loan program is the small balance, the Neighborhood Connection Small Balance Loan. Okay, so the one I just mentioned, that's the Neighborhood Connection First Mortgage Program for your primary residence. The second one is the Neighborhood Connection Small Balance Loan. Okay, so that one goes up to $10,000 as long as you have a credit score of 620. Oh, I'm sorry, I forgot to mention. For the primary mortgage, we can go as low as 580 credit score. Okay. But if we go anywhere between 580 and 619, you would have to come with a down payment of at least 3%, okay? But that gives you some flexibility because you may have a lower credit score. That gives you, a different option. And same guidelines pertain to the small balance loan. As long as you have a 620, you would be eligible for a $10,000 loan that can go towards home repairs or debt consolidation, okay? Now, the sweet thing about that one is, let's just say if you can only qualify for $100,000 for a loan, that small balance loan can, I'm sorry.
He's real daddying. You're on mute, Maurice.
Oh, okay, I'm glad I was on mute.
Okay, that small balance loan, what?
All right, so yeah, the small balance loan. So that if you let's just say if you're trying to qualify for a loan, a larger loan amount, that small balance loan can be used to pay down some debt that you may have. So let's just say you got some high interest rate credit cards, and you're making monthly payments that are pretty high. That small balance loan can be used to consolidate that debt into one payment. And that small balance loan is amortized over 10 years. Okay. And the interest rate right now is only 3.75%. Okay. So that's all. Let's just say if you did $10,000 and you have to pay it back in 10 years at 3.75%, you're only looking at $100 payment. So let's just say if you have some high interest credit cards, or maybe you got a car loan that only has like $9,000 left in repayment, but you're paying like $350. A $200 or $250 difference in monthly payments can really mean a lot as far as the amount of loan that you're pre-qualified for. Okay. So that's where that small balance loan can really come in and help give you a good deal. All right. But it can also pay off other things like a tax lien and a judgment, so long as it's less than $10,000. So that's our neighborhood connection loan program.
That's really neat and really helpful, because a lot of times people don't have access to capital. It's not that they don't want to pay stuff out, but in the example that I gave about reaching out to LexisNexis, let's say, for instance, if you had a judgment or a lien from Missouri Sewer Water District or something that you needed to pay off, or if they ran title on you, which is something that they do during the home buying process, and there was a lien that popped up that you didn't know about, those funds can be used to help you to resolve that lien so that you don't have to give up on your dream of home ownership. So let's see, we're going to, when shopping for a loan, what are some good things to do? You want to inquire with HUD-approved agencies for reputable lenders or programs, because they're going to, when you're going through this process, I mean, you really don't know who to trust, who to go through, who to ask. So my recommendation would be that you reach back out to your contact at Prosperity Connection and say, look, I'm looking to do this, or I'm looking to buy a house. Who do you recommend? The reason that I suggest that you do that is because this is what they do every day, and they know who has a good reputation and what lenders have the programs that you may be eligible for. So they'll be able to give you some good recommendations. You also want to look at your bank or credit union, whomever you personally bank with, and see, do they have any programs that you may be interested in. You can also ask for referrals from your friend and families,
Crystal, did you answer that question on the small balance loan? Sorry to interrupt.
I didn't see it.
Okay. Looks like Tiffany had a question on the small balance loan. So it's a small balance loan for the mortgage or credit card loan. So you got two different loans. So the Neighborhood Connection First Mortgage, that's for your primary mortgage. So whenever you're purchasing a home, that's going to be used to finance that purchase. The small balance loan, Neighborhood Connection Small Balance Loan, is for debt consolidation or for home repairs.
Does that answer your question, Tiffany? I hope so. If it didn't, let us know.
You can type yes later on or say yes.
All right. So tips for selecting a lender. You want perfect. All right. You're welcome. So you want to look locally. Oftentimes you'll hear things on TV, Quicken Loans, Rocket Mortgage, and I'm not discrediting them. I'm sure that they're great companies. But if you're trying to look into some local resources to help you, you want to work with local lenders and local organizations like Prosperity Connection, because they're going to have their finger on the pulse of what's happening and where the community resources are that you may be able to take advantage of. You want to interview a couple of different people to determine their rates and loan estimates, not a good faith estimate, or the loan estimates and loan recommendations. You want to have more than one opinion, and you want to evaluate your loan officer's response time and ask them how long it's going to take them to process and underwrite the loan. Because if you have to be out of your apartment in, in 45 days, and they're telling you it's going to take them 60 days, then that may be a deal breaker for you. You want to see how your loan officer is communicating. Are they breaking it down to you in a way that you're able to understand and apply the information that they're giving you? And are they following up? Are they patient and answer all of your questions and help educate you about the process and what to expect? Because I think that purchasing a home is a stressful process. So having your expectations correctly set in the beginning helps to alleviate stuff that will just get things thrown out of proportion. When you are talking to different lenders, I suggest writing down what you're going to say and quote the exact same scenario to each lender that you talk to, because leaving out small details can make the difference or mean the difference in between whether or not you qualify for a portfolio program or not. I would err on the side of caution with lenders that are recommended by the seller or a seller's realtor or another party that's interested in the purchase. And the reason that I say that is because there may be some ulterior motives associated with it. When you're driving around on Sunday looking at different homes and say, oh, that house looks nice, I really like that house, and you see a realtor sign in the yard, that realtor works for the seller of that home or for the owner of that home. Yes, they're willing to show you the home to help to get it sold, but that realtor is not working for you. That realtor is working for the seller of that home. Now, there is something called dual representation where the realtor can represent both you and the seller, but their initial responsibility is likely going to be to that seller and not to you. You want to make final comparisons and choose a lender that you feel comfortable with and who's providing you what you feel is the best service, because at the end of the day, it'll be you that's making the payments.
And also, I'll just add too, Crystal, that a lot of times, things come up, with every transaction is going to be different. And, underwriters may have questions, processing team may have questions, even management may have questions pertaining to a file. And if that lender hasn't taken their time to get to know your circumstance, your current job situation, if you don't think they're going to fight for you, if something comes up, that's something else to consider as well. If they have, 100 other things on their plate, they're taking forever to get back in touch with you. The probability of if something does come up on your file and them really kind of going to bat and making sure your file is getting through is going to be low. So
I agree with that. When you're comparing different loan programs, these are just a couple of things that you want to look at. And you'll have to see where your particular sensitivities are, because some people may have more money to pay towards a down payment. Some people may have less money to pay. But you want to look at your loan program in terms. You want to see, what type of loan is this? Is this a conventional loan, or if this is a FHA loan or a VA loan or a government loan that's assumable? Like I mentioned, my client who was a senior citizen, the loan being assumable was something that was important to her. She could have qualified for a conventional loan. She had great credit and she had the money to put down. But it was more important to her for her daughter to be able to take over the loan would she have passed. The down payment, that could be a deal breaker for you. If you know you need $5,000 and you don't have anywhere to get it from, you can't get it from a first-time home buyer program because you make too much money or you don't qualify for some reason, you don't have it, that's a deal breaker. The total closing cost. If there are a lot of fees associated with the loan and you do not have the funds to absorb those fees, you want to look at that. Compare apples to apples when you're looking at those different types of loans. You want to see what your upfront costs are. Is the lender trying to charge you a fee just to do your application? There may be a red flag, and it could also be a deal breaker for you. You want to look at the interest rates and the APR. When it comes to your APR, your annual percentage rate, The best way, I think is confusing to explain, but the best way for me that I've learned to understand the APR is that if a lender quotes me a specific interest rate of, let's say, maybe 3%, but then I get my loan estimate documents and I see the APR on there and it's 6%, then I know that there are a lot of fees and stuff and junk fees and stuff included in there. But if they quote me a rate of 3% and I see my APR is maybe 3.8 or something like that, then I know that there are not a lot of fees associated in there. So if it's a huge disparity in the APR and what the interest rate is, then you know that there are a lot of fees. And you don't want to fuss. Just make sure that you get some, actually start search around with some other lenders. And also then the payment. If one payment is $800 a month and another payment is $1,100 a month, and it's for the same house, the same loan amount, you want to figure out what's making the difference there. When you're looking at your various loan types, your fixed rate mortgage is just that, it's fixed. When you sign your security instruments, which is your note and your deed of trust, it's going to have your loan amount and your interest rate and your amortization on there, and it's going to be fixed for the life of your loan. So if you got a 15-year, 20-year, or 30-year loan, it's just going to be fixed. An adjustable rate mortgage is one that's variable. It can move up and down, and sometimes it can move annually. Sometimes it can move every 3 years, 5 years, 7 years. I would say adjustable rate loans get a bad rep. They're not bad. You just have to have the liquidity to be able to deal with any movement in the rate. Oftentimes the adjustable rate mortgage, the introductory rate is going to be a lot lower, but you have to be able to anticipate a rate hike and be able to deal with it. You also
have to be strategic too. I'm sorry, I didn't mean to interrupt.
Go ahead.
But like just being strategic, because you may be a traveling nurse and knowing that you're not going to be here very long, but you're probably here for the next 2-3 years, and you probably don't want to pay rent. You probably realize that, hey, if I buy a home, my mortgage payment's going to be lower. An adjustable rate mortgage will come in handy in this situation, because a lot of times the pricing is usually more favorable than fixed rate mortgages. The rate sometimes can be a little bit favorable as well too. And by the time you're getting ready to move out and you sell it, that term won't have come up yet. So it's just something else to consider as well.
I agree. All right, you also have your balloon mortgages, and your balloon mortgages is where they will start with the amortization at one term, but the loan is actually due in a shorter term. So a balloon mortgage will mean that your amortization, or basically the length of time that they have calculated your mortgage payment for, is over 30 years, but it's actually due in 15. So you're starting off with this $100,000 loan. They say, okay, we're gonna amortize that over 30 years, and that's what your payment is going to be based off of. We're going to give you 30 years to pay this back, but in 15 years it's actually due. And so a balloon mortgage can be very, very dangerous if you're not prepared for it. So if you got a balloon mortgage, you know, in year 12 or 13, you need to be looking at refinancing into a more fixed rate type of option. So let's look at some loan cost comparisons on a $100,000 loan. And this is where interest rates are so, Miss Denise Carter, I was trying to type that together for you, but I didn't get a chance to finish putting everything in there, but I'll finish it up, or yeah, I'll finish it up later. But anyway, so $100,000 loan, or $100,000 30-year fixed rate loan at a 4% interest rate, you're gonna end up paying an additional $71,000. $72,000 for that loan. At a 6.5%, you're gonna end up paying almost an additional $130,000 for that loan. So instead of paying back $100,000, you're paying back $171,000 at 4%, or $227,000 at 6.5%. So you want the lower interest rate. But let's say, well, Crystal, I can't get a lower interest rate. My credit isn't where it needs to be. This is the lowest interest rate that I can get. The other thing that you can do, that's just because this is where you are right now, is not where you'll necessarily end up. But the other thing that you can do is possibly pay more on your principal balance as you have the ability to pay your house off sooner. If that's something that you opt to do, here's my recommendation for that. Write a separate check for the overage that you want to apply towards your principal balance, and then reconcile that on an annual basis. So when you close on your home, they're going to give you something called an amortization schedule. That amortization schedule is going to show you how much you owe on the balance of your loan with each payment that you make. So if you make your regularly scheduled payments, it's going to show you what the resulting balance is. You want to keep that paper, because anytime you make an extra payment on their principal balance, you want to deduct that from what you owe. At the end of every year, you want to go back and reconcile it and make sure that those extra payments that you paid in were applied correctly. Oftentimes, they'll have people working in the servicing department that may get the money and may apply it towards interest or something else. And if you wait too long to try to reconcile it and catch it, they may not be able to find it. But once you have your home, if you make it a practice to go through and reconcile your payments to show how much you owe every single year, then if there was anything that was misapplied, you'll be more likely to correct it. Key mortgage terms. So these are some of the terms, I call it mortgage jargon, that we have learned, that not necessarily learned, that we've used today. We're talking about loan to value, debt to income, prepayment points, locked in terms, and rate lock versus floating rate. A lot of those terms seem so confusing when you're going through trying to purchase a home. One resource that I know of that I found to be very helpful to customers is the CFPB.gov. So www.cfpb, that's the Consumer Financial Protection Bureau.gov. They have a really robust glossary with all of these terms in there that you could save an electronic version of it. You don't even have to save, you can just go there at any time and go in there and look at it and look up some of those terms to just kind of help you to familiarize yourself with some of the jargon that's used when you're going through the process. I think that's important because it helps afford for a more fluid conversation, because sometimes people just have the tendency to just talk in terms that are familiar to them, but may not necessarily be familiar to you. So I like to find resources to help me to educate myself. And the glossary at the CFPB.gov was one of those resources that I found. So I would encourage you to take a look. One of the terms that you'll find on the CFPB website is a closing cost term that I just want to spend a little bit of time on. And this term right here is called interim interest. So these fees right here that you see, these are your just some typical closing cost fees. Remember, I mentioned to you that when you're going through a mortgage transaction, you have your down payment, which is the difference in between the sales price of the house and the loan amount that you get from the bank. And you also have your closing costs, which are fees that are ascribed to you to complete the transaction. You have loan fees, interim interest, homeowners insurance, escrow reserves, title fees, appraisal fees, and mortgage insurance. Interim interest is the interest that you pay until you get to the end of the month. For example, if you were to go to rent an apartment today is April the 8th, they would prorate your rent from April the 8th until April the 30th, however many days are in April, right? So you don't have to pay those first 7 days that were in April. You just start from the day that you rented the house until the end of the month. And then you start making your monthly payments every month after that, right? Well, with homeownership, it's a little bit different. You would pay interest for the day that you close on your house. Let's say, for instance, you was buying a house at 123 Sesame Street. You would pay interest from April the 8th until April the 30th, the last day of the month. and then you don't make your first payment until June. You get to skip the month of May. You get to skip the month of May because a mortgage is paid in arrears or once it has had an opportunity to accrue interest. So you pay interest from the day that you close to the end of the month. You skip a month, and then you pick up the beginning of the following month. It's a little weird, but that's just the way that it works. What are some other loan fees? Your loan application fee. Most banks don't charge that upfront. If you have a bank that's charging you a loan application fee upfront, I would probably err on the side of caution and not work with them and check in with Carol and Yvette. Your credit report, your appraisal fee, as Marie said, your processing fee. So you have a couple of people when you're going through this process. There are lots of different moving parts and there are lots of different people. So you have you have your realtor, you have your loan officer, you have your processor, you have your underwriter, you have your appraiser, you have your inspector, you have your closer. There are lots of people. And there are fees associated with a lot of them. Most of those fees are bundled up where you don't see them segmented, but some of the fees that you do see segmented are the ones that we have listed here. One of the things that people don't really understand is this points to reduce interest rates. Interest rates are so low right now. So if someone decides or offers to charge you points, I would make sure that you have a clear understanding on the math of that to see how that works and how it's going to be beneficial. Because again, interest rates are they've gone up some, but they're historically low. So I don't think that it's, I can't say worth it because everybody's situation is different, but if someone is going to charge you points, again, make sure you have a clear understanding on the math for that and that you get a second and maybe even a third opinion before you agree to pay those points.
It also depends on how long you plan on staying in the house too, because you probably, depending on whenever you're going to break even means when you'll actually start saving money by lowering your interest by paying points. If you're not going to be breaking interest for, let's just say 10 years, breaking even for 10 years, maybe even 5 years, it may not be worth it, like Crystal said, because rates are so low right now that you really won't be paying that much in interest from a historical point of view, because historically rates are low.
I agree. When you are applying for a loan, you want to just discuss those loan options and fees, make sure you understand them, review all the information with the lender and agree to the terms of the loan, sign all your documents, and provide the documents that are necessary to complete your application, which are things like your pay stub, your bank statements, your W-2s, tax returns, things of that nature, and pay any upfront fees that are required from you. Once you do that, the processor and underwriter are going to get involved. They're going to review your loan application, your credit report, and all the documentation you provided and make sure everything matches up. They're going to look at your appraisal and your flood search to make sure that you're not in a flood zone. They're also going to review the title to make sure that there are no liens or encumbrances on your title. But you won't have that because you would have contacted LexisNexis. And so you'll know what's out there on you. They're going to verify your employment and your income tax return. And they're going to verify that the income tax return that you provided to us matches what the IRS has on file. And they're just going to confirm that all the information you provided matches and meets our lending guidelines. So what are some reasons for declined loans? Too much debt, not enough savings. Your appraisal value is too low. The condition of your home is poor or your credit is poor. You don't have enough credit history or your scores are too low. There was a change in process, a credit change while in processing. Maurice, you want to talk about that or you want me to talk about it?
I think you probably have the worst horror story.
So, when you get ready to purchase a home and you're right there on the cusp, you're right there on the edge, everything is going good, you're ready to move forward. and you get excited. You see everything that you want, everything at Lowe's and Home Depot and Home Goods and Marshalls and Michaels. All this stuff starts to look good, particularly new washers and dryers and for refrigerators. So you are in the middle of getting ready to purchase your home. You go into Lowe's and they tell you, hey, you can get this washer and dryer with the refrigerator with the TV in it. You can push a button and see through it, and you can get it, and we can put it on credit, and you don't have to make a payment for 6 months. And you say, okay, great. I will be in my house and I'll have a nice new swanky refrigerator. Well, they have pulled your credit and now you have a new debt on your credit report. That's a credit change while your loan is in processing. And so now you no longer qualify for your mortgage loan and your loan has been denied. So you got a nice new refrigerator, but you don't have nowhere to put it. So with that being said, don't do that. When you are going through the home loan process, don't have any changes in credit. Don't let anybody pull your credit. Don't apply for anything. Save your money. Don't spend any extra money. Be very, very skeet on your expenditures because you want to keep everything status quo. You don't want anything to change. Even the smallest thing could have an adverse effect on you. I had something similar happen to me. I had a client who was purchasing a home and his wife got excited and she went to Ashley Furniture and bought a couple of $1,000s worth of furniture. And she bought it. She applied for it, but she put his name on there as an authorized user. And he was the one that was getting the loan. And it messed up the entire transaction. And so you would think, well, why didn't you just take him off? Or why didn't she just take him off? Well, because Discover was a card that she did it on. And Discover, it took them 72 hours to get it off. Well, that 72 hours was just enough time for them to be out of the commitment phase of a loan when you have a commitment date that you have to meet on your contract. There was just enough time for that seller to pull out. Why did that seller want to pull out? Because they had gotten the appraisal back and the appraisal of the house appraised for maybe $20,000 or $50,000 more than what he was selling it to them for. So he knew that he can make more money off the selling at home. So he pulled out and they lost their home. Now they call me everything except for a child of God. But I told them not to, no changes in your credit history, but she felt like she can go out and get her furniture and just, include her husband, but it messed everything up and they lost their home. So don't let that be your story. Title issues. That can be another challenge. I had a customer who had really great credit, really great income. No, it was almost like a textbook loan. But when they pulled title, they found a lien on her. She owed $1 million in restitution. Yes, she had done some time for money laundering, but she'd been in jail, she'd done her time, served her sentence or whatever. But that lien, that restitution lien was still on her credit. And so it prevented her from moving forward with the loan. So we had to go another route in order to help her and her husband still be able to do the purchase. So we ended up having to do the loan in the husband's name and not the wife's name. But that's why it's important to make sure that you contact LexisNexis and make sure that there are no outstanding liens or anything out there on you. The other thing is that could be a reason for your loan being declined is if you're not able to get homeowners insurance. Homeowners insurance is almost like life insurance, whereas if something happened to you in the past, you had a terminal diagnosis or something, and you could have been healed and been, restored and everything would be okay. And everything could have been okay for years. But if you go and try to get health insurance, a life insurance policy, they'll be able to pull their diagnosis up from years and years and years before. And it'll be more expensive for you to get life insurance if you're even able to get it. So if you're not able to get homeowners insurance, then a lender is not going to give you a mortgage loan simply because the property has to be insured. What are your rights of dealing with a predatory lender? You got a couple of different rights there, and they're important for you because you never want to have to deal with that. But a lot of people have had to deal with predatory lenders. So the Equal Credit Opportunity Act protects you because it prohibits discrimination. The RESPA, or the Real Estate Settlement and Procedures Act, protects you because they require you to have a loan estimate at application and a closing disclosure at least 3 days prior to closing. And the Truth in Lending Act requires that at application and closing, the loan estimate disclosures that show the interest rate paid and the APR and the amount financed are provided for you. How laws protect you. So again, they prohibit racial discrimination, credit discrimination based on your gender, your marital status, your religion, your age, or even your receipt of public assistance. Some people don't know this, but if you are a recipient of a housing choice voucher or Section 8, you can use that to purchase a home, and it's counted as income. They require that you have proper disclosure of your loan terms, and that lenders have to use the income from alimony or child support if you choose to do so, within the limitations that it has to have a likelihood to continue for at least another 3 years. And again, if you work part-time and receive public assistance, the lender must use all income, like I already said, Section 8. Who's protecting you? I already mentioned the Consumer Financial Protection Bureau, the CFPB. They restrict unfair, deceptive, and abusive acts by lenders, and they enforce the law. Lenders hate to get a letter from the CFPB, but if you file a complaint on them, the CFPB will investigate. And they help to monitor the financial markets, and they enforce the law. They really, really, really want to make sure that there's no discrimination or unfair treatment in consumer finance. And a lot of times minority income, minority areas are often recipients of that unfair and discriminatory treatment, but the Consumer Financial Protection Bureau is there as a buffer for that. So that is an organization or agency that you can reach out to if you ever feel like you have been discriminated against unjustly. Now, I've had people that feel like, well, you discriminated against me. I remember one time I was teaching a class, and there was a man in there. He was an African-American man, and he had it was over $1 million in medical debt. And I told him that I didn't see where he would just kept accumulating the debt, and I didn't see how he'd be able to get financed. And he told me he felt like I was discriminating against him. And I was like, he said, I'm just, I'm a Black man with medical debt and you're discriminating against me. And that wasn't the case. It was the fact that he had to take care of his affairs, and there were things that he could do, but he didn't want to do them. He just wanted his debts to be forgiven because he had fallen ill. But unfortunately, that's not the type of health system or democracy that we are under. So he had to take care of his affairs before he could get financed. Other enforcement agencies are HUD, the Department of Housing and Urban Development, the Federal Reserve, the Office of the Comptroller of Currency, the Federal Deposit Corp, or FDIC, the Office of Thrift Supervision, and the National Credit Union Administration. And I think that is it. Are there any questions? I think that's it. I used to have a thank you thing at the bottom, but I think I don't have anything. Are there any questions about anything?
If you have any questions, this is the time to unmute and ask.
I'm certain somebody has some questions. And if you don't have questions,
are y'all watching the baseball game?
No.
They asked a good amount of questions during, so they may not be, but yeah, this is a good time.
I was trying to answer one of the questions by Ms. Carter while we were going through the presentation. She wanted to know about the documents and the checklist of things that she would need, or step-by-step process of what to do. So I told her 2 years tax returns, 2 years of W-2s, most recent 30 days paycheck stub, most recent 2 months bank statements. I know she's gonna need her ID, but I know that's the beginning. Is there anything else I'm forgetting?
No, that should be it.
At least that'll be a good start. So when you're starting off with this, I would start there. If you are unsure as to whether or not there are any liens or anything that are on you, you could also start by reaching out to LexisNexis and having them to do an investigation to make sure that nothing pops up and that you get anything situated that does pop up. You can also, another really, really good place to start would be scheduling your meeting with Prosperity Connection and having them to take a really thorough look at your credit and to see where you are, to give you a good idea, because they're going to be able to do an assessment on your credit better than what you probably could. And let them just look at it and give you some ideas about some things that you may be able to do to put yourself in a better position. Carol, is there anything?
Hi. Yeah, on one and do that home buying, check over. Our coaches can do a soft pull on your credit that won't affect your credit score and kind of go over that with you. And then if there are things that need to be looked at and worked on, they can help you through that process as well. When you call our number, it's 314-256-3995. I can throw that down in the chat, and I'm the one who answers the phone. So I work here at home, but the phone rings on my laptop just like it does at my desk at the office if I happen to be there. But I always say leave a message, because there's most of the time I'm sitting in on a class or I'm in another Zoom meeting, and if I don't I can't answer, and then some people just don't leave a message, so I need you to leave a message so I can call you back and set that up. But yep, so our coaches can definitely help that process, and we have helped a ton of people through this, so they know what they're doing. Yvette, did I miss anything?
No, you didn't. I was just going to type the number in again in
Oh,
the chat,
thank
but
you.
I couldn't remember.
256
314-256
3995.
3995. I'll never remember that number. I've accepted it.
Yeah. And you can also send an email. We have our email address, which is hello. Yeah. What is it?
Hello at Prosperity. I'm typing it in,
Okay,
connection.org.
thank you. Yeah. And if you were in this class, just remind me, say, hey, I was in the home buying class the other night and I want to do XYZ. And so that'll be good. And I usually, when I send a message to the coaches, I'll say, hey, this person was just in our class with Crystal and Maurice, and they're ready to get going. So that's kind of how it works.
Do I need to gather those?
I'm sorry, what'd you say, Ms. Carter?
Do I need to gather those documents before I make the call, or
when you call me, that's kind of your initial step. So start working on it, but then make the call, and then it usually give our coaches a couple days to respond. So in that time frame, that's when you should probably be gathering, just so you're ready.
You ask for a 2-day time frame for the coaches to respond.
Yeah.
Okay. All right. Thank you.
Mm-hmm.
I would just say kudos to everybody for attending. This is a great first step. Studies show that people who participate again in these types of trainings and invest in their education about home ownership have a more successful home ownership experience, because they know what to anticipate and their expectations are level set, and they are aware of the local resources that are available to them. And that's another reason why I advocate for looking local for your lender versus going to a Quicken Loan or just working with somebody on a phone, because this is the largest investment that you would likely ever make. And you want to be able to, reach out and talk to someone if you really, really need help, and not necessarily be on hold for 45 minutes trying to reach somebody.
Yes.
But that's
Are
all.
there any other questions?
I don't have anything.
No? Okay. I'm going to stop recording.
All right.
All right.